The EPA just finalized the most aggressive methane regulations in industry history. Quarterly inspections are mandatory. Third-party flyovers, hunting violations. Yet some Permian operators are treating this as a competitive advantage, not compliance burden. Well, that split tells you who survives the next decade. In 4 minutes, you'll discover how laser-based methane monitoring just got full EPA approval to replace manual inspections, and why 85 per ton tax credits are making carbon capture more profitable than the oil itself, and where the real decarbonization race is separating operators with structural cost advantages from those facing extinction at $60 oil. I'm Mark Roach, petroleum engineer and deal maker with 30 years of experience in this business. This is FutureWise Energy, an independent analysis. Long Path Technologies just became the first continuous monitoring system to receive full EPA approval, replacing traditional optical gas imaging inspections across all sensitivity tiers. Well, that's not incremental, that's infrastructure. The company uses open path laser spectroscopy, creating detection grids across entire well pads, monitoring 24/7, 365 days a year with accuracy down to 0.02 kilograms per hour and 0 false positives. A single installation covers 8 square miles. The Pathfinder program aims to blanket 25 million acres across every major U.S. production region by 2030, monitoring tens of thousands of facilities through subscription services. The regulatory catalyst is extraordinary. EPA's December 2023 methane rule requires quarterly OGI inspections at most oil and gas sites. More significantly, the super emitter programs allows EPA-approved third parties to conduct flyovers, hunting compliance violations, creating unprecedented exposure risk for operators. Well, Long Path's approval transforms this from liability to asset. Operators using the system gain protection from super emitter flyovers while simultaneously capturing operational intelligence on leak duration and product loss. The Department of Energy finalized a $162.4 million loan guarantee in October 2024, financing construction of 1,000 remote monitoring towers. The project prevents 6 million metric tons of CO2 equivalent emissions annually, equivalent to removing 1.3 million gasoline vehicles from roads. Vital Energy expanded partnership to cover 70% of gross operated oil production in the Permian. The subscription model, well, it makes it economically attractive even for smaller operators accessing shared infrastructure. For Permian producers, this is more than compliance technology. It's certification infrastructure supporting ultra-low methane intensity credentials, increasingly demanded by buyers paying premiums for responsibly sourced gas. European Union methane regulations take effect, requiring LNG importers to demonstrate low emissions intensity. Permian gas producers with continuous monitoring records gain significant competitive advantage in global markets. Methane monitoring evolves from compliance checkbox to core operational capability. Operators establishing continuous monitoring now build multi-year data records demonstrating emissions performance, potentially valuable in carbon offset markets, tax credit programs, or future regulatory frameworks rewarding documented reductions rather than estimated calculations. Now flip to carbon capture. Section 45Q tax credits enhanced by Inflation Reduction Act and maintained under Trump administration's 2025 legislation provide $85 per metric ton for geological storage, $180 per ton for direct air capture. The 2025 legislation equalized credits for enhanced oil recovery, raising them from $60 to $85 a ton making CO2 EOR economically competitive with permanent storage. The economic impact is transformative. At 85 per ton, a facility capturing 1 million tons annually generates $85 million in tax credits, often exceeding project operating cost before considering product value. CF Industries announced its Donaldsonville project increases free cash flow $100 million per year due to 45Q credits. Well, the Permian Basin is uniquely positioned. The region hosts extensive CO2 pipeline infrastructure built over decades, including the world's longest-running CO2 EOR project at the Sackrock field. It's been operational since 1972. This existing infrastructure dramatically reduces capital requirements versus greenfield developments. CO2 EOR in mature operations like Means San Andreas unit recovers 3 additional barrels per ton of injected CO2. Combined with 45Q credits, operators receive payment for both incremental oil and permanently sequestered CO2, a dual revenue stream fundamentally changing project economics. University of Houston research indicates brownfield CCUS-EOR projects benefited from existing wells, surface facilities, water flood infrastructure, extensive reservoir data, allowing CO2 handling integration with minimal modifications. Proximity to CO2 sources, both anthropogenic capture facilities with natural deposits, enhances viability. Importantly, CO2 EOR provides permanent sequestration as production byproduct. High percentages of injected CO2 remain in reservoirs over geologic timeframes. Once EOR becomes uneconomical, infrastructure transitions to dedicated sequestration, creating pathway from production enhancement to permanent storage. So ExxonMobil's 2024 acquisition of Denbury for $4.9 billion provided ownership of the largest CO2 pipeline network at 1,300 miles plus 10 onshore sequestration sites. The company secured third-party contracts representing 9 million metric tons annually with projects for Linde, Nucor, and New Generation Gas gathering starting in 2026. CEO Darren Woods stated that the low-carbon business is potentially, can outperform legacy oil and gas within a decade. Occidental Petroleum's Stratos facility in the Permian is designed to capture 500,000 metric tons annually, and it received first ever Class 6 permits for DAC in April of 2025. Capital costs exceeded $1 billion, with $550 million from BlackRock and $650 million from DOE grants, plus substantial 45Q credits at 180 per ton. Occidental's strategy integrates DAC with EOR, using captured atmospheric CO2 for production enhancement while achieving net negative emissions profiles. Shell, TotalEnergies, and Equinor expanded Northern Lights CCS with $714 million investment, tripling capacity to 5 million tons per year. The project provides open access storage offshore Norway, a model potentially replicated in the Gulf of Mexico. Despite momentum, policy uncertainty does remain. Wood Mackenzie revised 10-year CCUS forecast down 22% due to U.S. policy uncertainty and slow Asian policy evolution. Bloomberg NEF projects global capacity will surge 28-fold by 2050 to 2,061 million tons annually, but achieving projections requires sustained policy support, technology cost reductions, CO2 transport and storage infrastructure at massive scale. For Permian operators, developing CCUS strategy is no longer operational. Whether through EOR integration, third-party sequestration agreements, or hub partnerships, operators must position to access value created by 45Q credits while meeting shareholder expectations. Early movers secure best sequestration sites, lock favorable infrastructure access, build operational expertise navigating increasingly carbon-constrained futures. Enhanced rock weathering represents one of the most scalable carbon removal pathways, accelerating natural geologic processes, sequestering atmospheric CO2 for millions of years. Spreading finely crushed silicate rocks, primarily basalt, on agricultural land converts CO2 into stable bicarbonate ions, ultimately flowing to oceans where they're stored for millennia. Research published in Nature suggests ERW deployed with crushed basalt on U.S. agriculture could provide net carbon removal between 0.16 and 0.30 gigatons per year by 2050. Globally, estimates indicate clear potential achieving gigaton scale capture within decades. Most compellingly, ERW delivers co-benefits, making it economically attractive beyond carbon removal. Basalt releases essentially nutrients, including calcium, magnesium, potassium, and improving soil fertility and crop yields 5 to 40% in field trials. The process increases water retention, reduces oil acidity, replacing agricultural lime, builds resilience against droughts and pests. These ergonomic benefits create revenue streams for farmers independent of carbon credit sales. Lithos Carbon's largest enhanced weathering supplier secured $57.1 million from Frontier Climate, backed by Stripe, Alphabet, JP Morgan Chase, to purchase 154,240 tons of CO2 removal between 2024 and 2028. Price fell 26% since the initial 2022 pre-purchase, with projections reaching $100 per ton by 2030. Lithos deployed technology on over 80 farms across 9 U.S. states, with 160 acres on waitlist. UNDO won $100 million X-Prize carbon removal competition in 2025, enriching 54,000 acres, removing 69,000 tons, targeting 1 million tons annually by 2025 and 4 billion tons long term. Microsoft signed 28,900 ton removal agreement with UNDO. While ERW deploys primarily in agriculture, relevance to oil and gas industries operates through multiple pathways. Major oil companies invest in ERW as part of diversified carbon removal portfolios. Occidental Petroleum, through Oxy Low Carbon Ventures, explores enhanced weathering and nature-based solutions, recognizing no single technology delivers gigatons of removal needed for net zero targets. The oil and gas industry generates enormous alkaline waste materials potentially utilized for ERW, creating circular economy opportunities. Mine tailings, cement kiln dust, industrial byproducts often contain reactive minerals suitable for weathering. Companies like ZeroX pioneer mineral waste and basalt byproduct use for ERW, reducing costs and environmental footprints. As corporate carbon accounting evolves, upstream operators may purchase ERW credits offsetting Scope 3 emissions from downstream combustion. ERW credits gain recognition as high integrity removals due to permanence measured in thousands of years, scalability potential, co-benefits. Well, MSCI Global Carbon Credit Price Index, it's a mouthful, shows higher quality credits command significant premiums. The spread between high-rated and low-rated credits reached over $7 per ton by year-end 2025, implying approximately a 360% premium for quality. The primary technical challenge for ERW is accurate measurement and reporting verification. Unlike point source capture, where CO2 gets metered, ERW relies on measuring dissolved weather products in soil, groundwater, river networks, and complex undertaking, that requires sophisticated monitoring. Companies develop multiple approaches. Lithos uses isotope dilution technology monitoring river networks for bicarbonate transport. Econ integrates sensors into existing agricultural soil testing. 0x deploys self-integrating accumulators measuring weathering products in situ. The carbon removal community converges on conservative accounting methodologies, avoiding overcrediting. Emissions tracking technology undergoes radical transformation. EPA's finalized amendments to Subpart W of Greenhouse Gas Reporting Program, which is effective for 2025 reporting year, with reports due March 31st, 2026. These represent the most comprehensive emissions reporting overhaul in decades. Key changes include granular reporting across all segments, direct measurement of emissions from major sources rather than engineering estimates, incorporation of advanced measurement, including satellites and remote sensing, identifying large release events. Amendments introduce other large release events category, capturing previously unreported emissions, closing persistent gaps between reported emissions and basin-wide flyover estimates. The EPA mandates continuous monitoring for certain emission sources, direct measurement for completions and workovers with hydraulic fracturing, verification of flare efficiency. Areas where traditional periodic investments and engineering calculations are no longer acceptable. Recognizing implementation complexity, EPA issued interim final rules in July of 2025, extending compliance deadlines. Most requirements originally due in 2025 have been pushed to January 22nd, 2027, providing operators time to invest in monitoring technology and establish compliant workflows. The compliance extensions highlight critical reality. The oil and gas industry lacks sufficient capacity and equipment and trained personnel to implement requirements rapidly. Service providers and technology vendors experience unprecedented demand for continuous monitoring systems, optical gas imaging equipment, and emissions quantification services. Lead times for some of this equipment has been extended to 12 to 18 months, creating bottlenecks for operators seeking early compliance. European Union methane regulation introduces even more complex compliance landscapes. EU regulation requires initial MRV reports by August 2025, measurement-based programs by February 2026 and 27. Critically, regulation applies to imported U.S. oil and gas, meaning U.S. producers selling to European markets must demonstrate EU methane standards are being complied with. This creates powerful incentives for U.S. producers, particularly those targeting premium LNG export markets, to adopt these continuous monitoring and rigorous MRV systems, satisfying both U.S. and EU requirements. The emissions tracking technology market rapidly evolves from intermittent manual inspections using optical gas imaging cameras to continuous autonomous monitoring. EPA began approving continuous methane monitoring systems like long-pass laser spectroscopy, Schlumberger's methane LiDAR camera, point sensor networks as alternatives to periodic OGI surveys, creating regulatory adoption pathways. These systems excel at detecting intermittent leaks, quantifying emission rates, providing regulatory reporting data, aerial and satellite monitoring from companies like Keros Aerospace, GHG Sat, and others provide regular flyovers, identifying large emission events across broad areas. Global environmental testing markets include emissions monitoring projects growth from $7.43 billion in 2025 to $9.3 billion in 2030, registering 4.6% CAGR, that's compounded annual growth rate. Within this emissions monitoring for oil and gas, it represents rapidly growing segment driven by regulatory mandates, corporate ESG requirements and commitments, investor transparency pressure. For upstream operators, strategic priority implements monitoring systems satisfying multiple regulatory frameworks simultaneously. EPA, state regulations, particularly in New Mexico and Colorado, international requirements for these export markets. The trend toward responsibly sourced gas certification, where buyers pay premiums for natural gas with verified low methane intensity, creates additional incentive for robust monitoring. Early movers establishing comprehensive monitoring networks and building multi-year data records position best to access premium markets as they scale. The voluntary carbon market, valued at $2.52 billion in 2025, projects growth to $3.04 billion in 2026 and $16.38 billion by 2035, reflecting a 20.6% compound annual growth rate. While projections are substantial, they represent significant reduction from earlier forecasts predicting that markets would exceed $50 billion by 2030. Recalibration reflects increased credit quality, scrutiny following investigative journalism, exposing low additionality projects, implementation of rigorous verification standards under core carbon principles, frameworks that have reduced corporate appetite for green hushing trends. Competition from compliance markets offering greater certainty. Despite challenges, carbon credit retirements continue growing. The first half of 2025 saw a record 25 million credits retired, demonstrating sustained underlying demand even as market structure evolves. Significantly, high-rated credit trade at more than 300% above lower-rated ones, a spread widening dramatically as buyers prioritize quality over quantity. Current carbon credit prices vary enormously. Voluntary market nature-based credits range from $7 to $24 per ton, premium projects reaching $20 to $20.30. Technology-based removals like direct air capture command prices exceeding $170 to $500 per ton due to higher cost and limited supply. MSCI Global Carbon Credit Price Index annual average declined slightly to 3.5 per ton CO2 equivalent in 2025 from 4.3 the previous year. However, MSCI rated BBB and above index rose from 5.60 in 2024 to 6.80 in 2025, an increase of over 20% year on year. MSCI rated BB and below index moved opposite direction, creating average spread of 5.1 in 2025, up from 2.90 in 2024. By year-end, spread reached over $7, implying approximately 360% premium for higher quality credits. In compliance markets, prices notably higher. EU carbon permits rose to 82.85 euros, $89 per ton in December 2025, up 21.52% year over year. California carbon allowances gained 12% over Q3 in 2025, pushing prices over and above 30 following cap and trade extension. The carbon market converges towards standardized contracts and quality frameworks, reducing fragmentation, improving liquidity. CORSIA carbon offsetting and reduction scheme for international aviation, ICE Phase 1 December 2025 contract rose 18% to $20.50 per ton, reflecting aviation industry demand. Core carbon principles established by Integrity Council for Voluntary Carbon Market provide clear criteria for high integrity credits addressing additionality, permanence, robust quantification, sustainable development benefits. Credits meeting CCP criteria command significant premiums as buyers seek defensible offsets amid heightened scrutiny. Bloomberg NEF long-term carbon credit supply outlook forecasts global supply could grow 20 to 35-fold by 2050, reaching 2.6 and 5.3 billion tons, depending upon the scenario. Expansion predicted on-market reset focusing integrity and impact. In BNEF high-quality scenario, theoretical supply rises from 243 million tons in 2024 to 2.6 billion in 2030 and 4.8 billion in 2050. Direct air capture emerges biggest winner, comprising 21% available supply in 2050, driving weighted average costs to $104 per ton. Average costs project or substantial rise as market shifts toward higher integrity projects. BNEF forecasts weighted average costs reaching $60 per ton CO2 equivalent in 2030 and $104 per ton in 2050 under high quality scenarios. Cost escalation reflects transition from low cost to avoided emission projects that are now many view very skeptically toward permanent removal technologies with higher operating costs but greater environmental integrity. For upstream operators, carbon offset market presents opportunities and risk. Operators with land holdings or mineral rights could develop offset acreage and create offset projects on their acreage, particularly nature-based solutions like reforestation or improved land management. More commonly, oil and gas companies buy in carbon markets, purchasing offsets addressing Scope 1, 2, potentially Scope 3 emissions. Strategic considerations including prioritizing high-quality permanent removal credits over avoided emissions credits to withstand stakeholder scrutiny, diversifying across multiple project types and geographies, managing delivery risk, integrating offset purchases with direct emissions reduction investments, demonstrating comprehensive climate strategies. The widening quality premium creates a dilemma. Buying cheap, low-quality credits, well, it risks reputational damage and potential write-offs if standards tighten. Premium credits significantly increase the cost of achieving net zero claims. Many companies respond by reducing overall reliance on offsets, favoring direct operational improvements, a trend potentially constraining a voluntary market growth even as the quality improves. The carbon market increasingly rewards transparency and robust monitoring. Operators with continuous emissions monitoring systems generating high-fidelity data position better to credibly participate, whether as buyers demonstrating real reductions or potentially as suppliers of avoided emissions credit from methane abatement projects. The technologies examined, from long-path methane monitoring to enhanced rock weathering to direct air capture, represent far more than incremental improvements. They constitute fundamental transformation of the industry's value proposition, creating pathways to produce hydrocarbons with dramatically lower carbon intensity, monetize legacy assets through novel applications, build competitive advantages in increasingly carbon-constrained global energy systems. Now, the common thread is convergence of regulatory pressure, technological maturity, economic incentives making decarbonization not just environmentally necessary, but financially attractive. Federal 45Q tax credit at $85 per ton for carbon capture creates revenue streams from exceeding project operating cost. Continuous methane monitoring eliminates regulatory compliance uncertainty while improving operational efficiency. Enhanced rock weathering delivers carbon removal at cost competitive with traditional offsets while providing ergonomic co-benefits, creating independent revenue. For Permian Basin operators specifically, the strategic imperative is clear. The region's position as America's dominant producing area creates both greatest exposure to methane regulations and the most substantial opportunity to lead decarbonization. Operators investing now in continuous carbon monitoring infrastructure, developing CCUS strategies, leveraging the basin's unique geology advantage, establish partnerships with emerging carbon removal providers, build durable competitive advantage as global energy markets increasingly differentiate based on emissions intensity. The market context, with WTI near $58 per barrel, natural gas just above $4 per MMBTU, rig counts down significantly year over year, reinforces the need for these investments. In capital-constrained environments where production growth slows, efficiency gains and premium market access becomes critical determinants of economic returns. Technology is simultaneously reducing cost, improving compliance certainty, unlocking new revenue streams through tax credits or premium pricing represent highest value investments operators can make. Looking to 2030 and beyond, the upstream industry divides between those embracing decarbonization as core strategy and those viewing it as peripheral compliance activity. The former command valuation premiums, preferential capital access, ability to sell into premium markets demanding low carbon intensity products. The latter face sustained margin pressure, increasing regulatory cost, potential market access loss as carbon border adjustment mechanisms proliferate globally. The technologies profiled here provide a toolkit for operators choosing the first path. Implementation requires sustained capital investment, organizational change, willingness to embrace technologies that are still progressing along learning curves. But for operators with vision, seeing beyond current commodity price cycles to structural evolution of global energy markets, the opportunity to lead rather than follow this transition remains wide open. The cycle turns when depletion, underinvestment, or genuine supply disruption finally exceeds efficiency gains, holding production aloft. Till then, the market rewards operational discipline and balance sheet strength. Position for the transition that's already separating survivors from casualties, because the premium for low carbon barrels isn't coming, it's here. I'm Mark Roach, and this is FutureWise Energy.